you know, we keep doing this little thing and this little thing, and the next thing you know, when you go to have heart surgery, you've got a $10,000 copay in order to keep the balance in, and I want to try to avoid that. Or if we do it, eyes open.
Well, I wonder if we keep giving exceptions, you know, at the point at which I get a flu vaccine next year, I'm gonna get a $10,000 bill because all the costs will have been shifted to me. For most of them,
And I
we
think
get
that's
free.
the concern. Every one of these is good causes.
Every one of them is a good cause, no question about it, but the sum total of them makes you really question the wisdom of this.
We do have a problem with health insurance, but that's this country. So anyway,
She's on her way.
she's on her way, good. Wood heat boilers, and then Doug Hoffer's gonna come in, and Tanya to talk about the mini chips and just their concerns or thoughts on that. And then I think after that, you can all go home.
Let's get her first then.
Well, I think the auditor tells us we built this, his bill. You have me to clean it. Let's make my notes. Not what they're supposed to do. Okay. So Senator, hello, we are taking up, 68, and we just thought we'd give you a chance to come in and tell us why you put it in, and then we'll start looking at it.
Thank you. Oh, look at this. This is service. I didn't bring my bill with me. I had it down for 2:30, so I didn't have. So we all know the issues associated with student loans, student debt, educational debt, and how significantly it's affecting our young people. And I think it also might be helpful to connect with AARP, because I've heard from them that there's a high debt load, student debt load with some of our senior citizens or the population. And I have reached out to them to try to get an indication of what the debt load is and the burden. We all know that having an educational loan can significantly delay one's participation in the workforce. And with the relief of that loan, folks can settle, buy homes, and be more productive economically. So the goal of this bill, I started talking with a friend, a constituent this summer, about what could we do to offer relief for student debt. And by the way, Senator Ginny Lyons for the record. What could we do to offer relief? And I know that last year you worked really hard on having a tax deduction for.
Did it on interest.
Yeah. Was it interest or principal? I'm trying to remember which one it was. And I know that there's other statutes that relate to tax relief for student loans. What this bill does essentially, and then let me just, before I get there, during COVID, there was a provision federally that allowed for an employer to let an employee deduct student loans as part of their business process. So an employer could give permission for the employee to deduct their student loan
Think,
from AGI.
because I was at a BSAC board meeting yesterday, there has been a suspension of loan payments during COVID. It's not ending until August, and essentially payments won't start up until the first of the year.
Okay.
So.
But I know, and I know that provision is not going to be renewed, that's going to end, so that's part of that discussion. Oh, the loan burden in the state is quite large. I tried to get an indication of that from Emily Byrne, from.
That's gonna be the bottom line, I think.
Yeah, it is, it's a bit, it's huge, it's absolutely huge.
And we've got a couple big, huge ask bills coming our way.
But then I look at it in the context of what happens if we make this the only student loan statute and deduction, and we allow for qualified educational loans, which are already defined in state statute. If we allow for that to be that's it, this is the only one that we're putting in place, we'll no longer have the bill that was passed last year, the statute that was passed last year, or others. It's ironic that I'm in here today because today the Supreme Court is considering the president's rule or proposal, his executive order around student loans, and we'll see where that goes with the states. Or some states were petitioning the Supreme Court. Anyways, so you'll notice in the bill that there are qualified taxpayers, qualified educational loans, and there are caps on income that allow for this to go forward. So it's not all loans, but it's for folks who are single who are $120,000 or less, and those who are married $200,000 or less.
And as I said, on that interest.
Huh?
I think those are the caps we put on the
Those
interest.
are the ones that you put on, the caps that you put on last year, and I thought that this would be the right thing to do. Getting the numbers, I really did try to get the numbers, and I had Abby Shepherd, I think, reached out to Craig Bolio, Commissioner of Taxes, about this. Mike Pichak was also very interested. We had a conversation about it. The benefit of doing something like this is that it allows for folks to get into the workplace and to feel a level of relief from that burden of education loans. If we can do it, I think it would be just an outstanding opportunity for Vermont to be in this situation. And of course, you're the Finance Committee. So weighing the risks and benefits of that based, within the context of revenue is that's your job. And I respect that, but I also think it's a bit frustrating for me when I see and hear from young constituents who have loans with compounded interest of 16%. And I know VSAC doesn't do that. I'm talking about VSAC. I'm talking about others.
Okay.
It's, so, okay, that's it. So, and I think, listen, if we had this in place, it would be a very attractive policy for young people who study in the state of Vermont to continue living here. That's it.
Any questions? Senator McDonough.
Based on does it make a difference on which state you went to school in, or?
Oh, I mean, that for me is, I think it should be a Vermont-based loan, educational loan. And whether you decide it should be a Vermont school, but we already have qualified education loans in statute. I don't remember the specific definition. And it's a qualified resident taxpayer, so it's someone who's employed and working in the state of Vermont. It could be a part of the business development.
But it would have, this would be a deduction from your Vermont state income tax.
Yeah.
I don't know if we could just allow you payment for Vermont schools, given interstate commerce rules and teaching, treating in-state and outs of state people, organizations, different stuff. Be something we could look at.
It's a qualified institution, so theoretically,
Well,
any state.
I think that's a technical definition for, you can't go to, yeah, there's qualified universities, that's more universal, not just accredited. Yeah, it's not just what we say qualifies.
Well, she was, she was supposed.
Okay,
I mean, I thought of the same thing, but then I felt like the value is that no matter what, they're in the state working to get the credit, which is what we really want. I think we want more people to feel attracted to be here and to work than as much which institution they
And
went to.
you can place other limitations on it, should that make sense. I mean, for a period of X number of years, after the first loan, for a period of X number of years, period. So,
I was curious if this includes medical school, and law school. And
I don't know what, as I said, I haven't re-looked up qualified education.
Okay, imagine we could get you.
Yeah, it probably doesn't matter where you spend it.
Mhm.
okay. Other questions? Thank you.
Well, I hope you'll just, try to consider it. I know it's a huge amount of money. I don't know what the revenue loss is. I just know there are a lot of loans out there that go in
But I think
billions.
it would also make Vermont more attractive. We've been told to have childcare
Mhm.
and
Exactly.
paid family leave, and they all come with big.
All of the above.
Right. I will just say one more thing, we're definitely like calling it to question that you might want to respond to, but to me, there's a difference between being very thrifty about where you go to school and like going to your dream school and spending a ton of money on that, or like paying for law school, sort of racking up student debt. So I might have the thought of like limiting, capping how much you, like what amount you can be deducting, say, I mean, I'm not gonna say something that gets people on my case, but like for less than $100,000, you can get a pretty decent education. You can probably go somewhere with a scholarship and, other forms of support, and not be hugely in debt. But I mean, I came to UVM because they gave me a
You
scholarship.
open up a huge area of discussion.
Yeah.
When you think about minority students and their access to some of the more expensive schools.
A
And
lot are very
then,
attractive for scholarships.
if you flip it,
Mhm.
this may actually open the doors for them.
What about parents that went into debt
Yes.
to pay for education?
Well, that's why I think reaching out to AARP might be helpful,
Mhm.
because I don't know what
Well,
that,
we've got them on the list. We'll see. I don't know if they have any. No one's ever asked me from AARP, but I found out they were sponsoring.
Well, I reached out to them.
I canceled my subscription.
I haven't heard back from them. And of course, VSAC, well, as you well know, will have input.
That's just for my mind. I was looking at the average cost of higher education as opposed to like someone getting a benefit up to paying for a huge amount.
Well, yeah.
On the other hand, if we put more money into our state colleges, maybe they wouldn't be in so much debt. So it's where are we going to put the money, which at this point, I don't think we have. We now it's told them.
And I'm very aware of the childcare issue and how important that is. So if this becomes a competitive piece, that's gonna be challenging for all of us. Yeah.
Okay,
Okay,
okay, good, thank you.
but I will say that this idea has attracted some attention outside of the state of Vermont. People are,
But no other state has done this.
yeah, I don't know if they're doing it.
Okay,
Okay.
Heather, Emily,
Thank you.
let you go back to the wonderful halls of appropriations.
I know, I'm actually sitting in my room. Maybe I should go across the hall.
Okay, I don't know, Ted, Ted is
Yes,
it?
I'll go.
Okay.
Yeah.
I'm like hanging out here in these comfortable chairs.
I'm here for support. Anyone have questions? No.
Okay, so Ted, before I've scheduled any real testimony on this, I'm just trying to get an idea on what kind of revenue are we foregoing and, yeah, is there any way to figure this out and how much of a plus or minus risk is there?
It is a tricky one. The testimony I prepared talked about some of the mechanics of what's going on and what some of the challenges we would have in estimating this. Right now, we don't have a number we could put onto it. It would definitely require a little more work and at the drawing board, so to speak. But if it were for the committee, I could talk a little bit about statistics of the overall kind of debt burden in Vermont, the number of borrowers, loan size, and if that would kind of help set the conversation, I could definitely talk a bit about that. Great, so I will share my screen. And so, yes, just very quickly, some snapshots of student debt, both nationally and in the state of Vermont. Talk a little bit about how this proposed policy would fit with the current student loan interest deduction federally and in the state of Vermont. And then finally, some considerations and things we thought about while starting to look at the numbers and also kind of how this fits with policy at the federal level. There we go. Just to start off, I mean, there's a titanic amount of student debt that is out there. The total amount right now is $1.7 trillion, and that is 36, almost 39% of all outstanding consumer debt. I put a chart here that shows where student loan debt is. It's more than credit card debt. It's just an astounding piece of what's out
It
there.
is more than credit card debt.
Yes.
Okay.
And just nationally, when talking about student debt, we're primarily going to talk about it federally because the federal government holds almost 93% of outstanding debt. And then to zoom into Vermont, right now, there's $2.9 billion worth of outstanding student debt in Vermont. This number has increased quite a bit with the payment pause because you have 3 years of origination of student
Because they
loans.
aren't paying it down.
Exactly, and there's no offsetting payments.
Yeah.
Exactly. And so there's 77,000 borrowers in Vermont with federal student debt. And on average, the average borrower has $37,000 in debt. We're slightly higher than the national average, but fairly close. And so talking about the three tax incentives that exist, we have the federal interest deduction, the Vermont interest deduction, and then where this proposed legislation would, how it would adjust the current deduction. So federally, it is the lesser of $2,500, so it's at capped at $2,500, or the amount of interest actually paid. It can.
I have to leave. I have a speaking engagement, Senator McDonald.
Fantastic. And so this interest deduction can also include your loan origination fees, capitalized interest, interest on credit cards if you use them to pay for tuition expenses. And you qualify if your Magi is less than $70,000 for an individual or $140,000 for a joint return, it starts to phase out at $70,000 and is capped at $85,000 for a single filer, and that it ends at $175,000 for joint filers. And you cannot claim the deduction if your filing status is married filing separately. And then I wanted to quickly show, this is the form that you receive from your lending institution if you pay more than $600 in interest. And so I highlighted this box number 1 because this is how the state of Vermont also gets information about the amount of interest payments that folks are making and would be able to deduct. This form does not include interest on principal. So we're only getting, part of the reason why this is so hard to estimate is we're only getting a slice of the overall amount of payments that folks are making.
Sir, should,
This is a federal form. We don't have any oversight. So if we do want to start deducting the principal paid that year, we'd have to have a whole separate Vermont form.
Yes, that would be a question for the Department of Taxes on how to implement that, but yes.
But this is a form for federal student loan interest.
That is correct.
Deduction, okay, just a student loan deduction at the top, and I was like, is there a form for that? There is no form for deduction of student loan payments, just the interest.
Correct.
Okay.
Yes, exactly. And so at the Vermont level, you may deduct interest payments that are not captured by the federal deduction. The AGI cap is 120,000 for single filers and 200,000 or less for joint filers. And so what the higher cap means that if you fall kind of in between where the federal cap phases out and the hard cap in the Vermont deduction, you can deduct the full amount of your interest payments. To a point of the question that was discussed earlier, taxpayers cannot claim the interest paid on a loan in someone else's name. So a dependent, for example, you would not be able to pay if you made interest payments on behalf of that loan. And so when we did the estimation on this bill in the last session, it was estimated to cost $2.2 million in tax expenditures. And since the first is for tax year 22, we just don't have the data now. Folks are filing their taxes and getting that deduction now, but we just don't have the data. And so I wanted to run through knowing, and so where S68 would fit into this, run through kind of where the different income breakdowns and what you'd be able to deduct for the Magi of less than 70,000. And so all of these numbers are for a single filer, just as an example. So at a Magi of less than 70,000, federally you can deduct up to $2,500 in interest payments. And then at the Vermont level, you would be able to deduct any interest payments above $2,500, and then you'd be able to deduct your full principal amounts. The principal deduction starts at $1. With a Magi of between $70,000 and $80,000, the federal tax deduction on interest starts to phase out. And then you can, at the Vermont level, you're deducting the difference between what you take in the federal deduction, your full amount of interest payment, and then same as before, you can deduct your full principal paid. And then between a Magi of 85,000 and an AGI, so numbers are slightly different, of 120,000, you would not qualify for the interest deduction at the federal level, but the full amount of interest and principal payments would be deductible on your Vermont tax return. So that is how the proposed legislation would play out. And so I wanted to present here some of the challenges and policy considerations around this. To reference what was said earlier, we don't have data on tax filers' student loan payments. So in order to go about this, you would have to make some pretty large assumptions about the amount folks are paying on their student loans. And then we don't know what you can't match up the income of that average. It starts getting really tricky. We don't have that connection. And then on the estimation side, which also on a future slide, there are a lot of different ways to repay your student loans, and it depends on income or the type of loan you have. And on the policy side, the biggest piece of this is that the federal policy at the federal level is unresolved right now. As mentioned, right, the Biden debt relief is headed to the Supreme Court this morning. And the pause on federal student loan payments is not ended. And so there's been many mentions of the payment pause ending. It keeps getting pushed down and further out in time. And then the other part in considering this is adding principal to the current tax deduction will impact a different group of taxpayers than the current policy does. And that's primarily because taxpayers they will benefit depending on where they are in the loan amortizations schedule. Right at the beginning of paying a loan, you pay more interest. At the end of your loan, you're paying more principal. And so as you can deduct principal as well, it changes your benefits. And then also thinking about folks, if they're on some sort of income contingent plan, those payments are they can be more interest payments. Interest is what happens first. And so if you're adding principal, it may not reach those people in the same way it would reach folks who are paying on a more traditional amortization schedule. And so to recap, data limitations, data on interest payments is reported on your tax forms. The data on the amount borrowers pay in principal is far more limited. I wasn't able to find a great number. Really, all I was able to find is kind of a consumer panel surveys, some averages. So that makes it complicated. And so your size of your monthly payment is ultimately going to be determined by your interest rate, your principal amount, and the repayment programs that you're enrolled in. And so taking an average kind of elides over some of that complexity. And so to go into how many different types of programs there are a lot of them. For direct loans, you can choose 3 different types of repayment, and that changes the amount of time and the size of the payment. It's complicated on that end. And then income dependent repayment. There are a bunch of different ways to do that as well, a bunch of different acronyms. And so this is just for the federal side. If you have a private student loan or a student loan that's kind of through VSAC, your loan's going to look different. And as I discussed earlier, that folks that by income, we don't have great information how folks are repaying. This slide captures some of that complexity. You can see at lower levels of income, there are larger shares of folks who aren't paying on their loans at all. In the middle incomes there, you can see that more folks, relatively speaking, are enrolled in income-based plans. And then as you get to higher amounts of income, they're more likely to be on a standard plan of direct loan, which has more traditional amortization schedules. And so another piece of this at the federal level is this would occur through rule, but there's a proposal for a revised income sensitive repayment plan. This would dramatically expand who qualifies, and it would reduce monthly debt burdens and payments. And so, for example, a first-year teacher would save $17,000 lifetime while pursuing loan forgiveness. The average graduate of a 4-year university would save about $2,000 compared to the current program. So this would factor into, if this went into effect, it would change the fiscal implications and costs to the state if folks are paying less on their loans. And then the final slide here is just talking about the state level policy and adding principal to the current deduction. As I mentioned before, in a traditional loan, first you're paying your interest and then you're paying principal. And so when you include principal to the deduction, you're going to benefit those who are at later stages of repayment because before they weren't able to claim that as a tax deduction. It will also benefit those with smaller balances, including principal at any amount, expands the number of borrowers and loans eligible. So for example, if you have 15.4% of Vermont borrowers have less than $5,000 in student debt, they would be able to benefit in a way they wouldn't from the current state policy because you would have to have a lot of interest and with $5,000 in debt, you may not get to that threshold. You'd be able to claim federally, but maybe not at the state level. The biggest piece of this is how does this fit within all the federal policy changes? The example of 15% of Vermont borrowers have less than $5,000 of debt. If the Biden debt relief plan goes through, their balances would be wiped out. Payments are, this is in Supreme Court, payments will not start until September, who knows, looking into a crystal ball. So in looking at this, I think it's wise to think about kind of all the moving pieces that are happening at the federal level. So that is all I have.
Questions, anyone? Sergeant?
I didn't see an estimate because of the vagaries of what this would cost, but when I do some back of the envelope math, which I just love because it can get me in trouble, I'm estimating that to fully deduct the principal payments based on what I expect to be about $48 million cost to our state revenues. Is that in the ballpark of what you guesstimate?
I would have to also guesstimate,
Okay.
but I can definitely, I don't know to the extent we guesstimate a JFO. Yes, but that's definitely a conversation I could have in the office, and at least we'll definitely, I think, work to the extent that this bill, if it does progress, definitely like to pin a more specific number on it.
Is your question based on a number of Vermont students?
The two figures that you offered at the beginning, and then guesstimating what they probably took out as a loan amount for a 10-year student loan and what they on average would be paying back in principal, and then based on a 6% income tax in the great state of Vermont, I came up with like 48 million, but it's in the tens of millions.
Yeah, I would have to
estimate.
Yeah.
Fair enough.
So that Senator Chip mentions that number that assumes that these are Vermont debts by Vermont students that are already being paid. And it's also been suggested that were students to come from another state with debt and then be eligible for this, that would be perhaps a recruiting tool to get young people to come here or get former students.
I do know for this current policy, you would have to be domiciled in Vermont.
What student
Yes.
They're paying.
you would be?
Do you have an estimate? Oh, sorry, thank you. Do you have an estimate on the cost of the charitable tax deduction for higher education donation?
That is a good question. I'll look in the tax expenditure report. If it's in there, I'm also looking at Emily right now. See.
Again, Emily Burke from the Joint Fiscal Office. I don't know if we break the charitable deduction out between higher ed or
Or other charities,
or other
okay.
charities.
Just a personal thought about giving them a tax break, but not giving the people paying to attend the institution a tax break. But I don't think it's the same amount of money. Probably not even in the same ballpark. Yeah, I have no idea.
Questions for the witness? And Ms. Byrne is not available. Oh,
No, I'm here. I was just
Yeah.
supporting Ted and for, so I don't have any other testimony to provide.
are you going to testify?
No, I was just here
We're
for
here
Ted.
to sound the alarm if something goes off.
If I started
going off the tracks.
If I started guesstimating, for example.
Yes.
Great, well, thank you.
Next one is S65, Sarah Teachout, who's
She's on.
welcome, Sarah Teachout.
Thank you, Senator McDonald.
Relating to commercial insurance coverage of EpiPens. I'm using that instead of the language that I don't understand here. Injectors. The floor is yours.
Thank you, Chairman McDonald and members of the Senate Finance Committee. I did speak on this bill in the past and gave you some information. So the two other things I wanted to mention are that currently the effective date is July 1st, 2023, which would have it be effective in the middle of a health plan year, which is problematic for changing insurance coverage. And then the second is there is missing language that must be included every time we eliminate cost sharing that says to the extent such coverage would disqualify a high deductible health plan from eligibility for health savings accounts pursuant to 26 USC section 2023, that's the IRS code. We have to add that provision. I will tell you that that's going to dramatically reduce the impact of this bill. Most of our members, EpiPens are a first tier generic drug. So most of our members that have standard copays do not have any copay for this drug already. And the only people who have out of pocket costs generally are those with high deductible health plans that this bill cannot impact.
Sorry, Sarah, were you kind of speaking for the industry or just like, I guess we're gonna hear from Claire about MVP?
I can speak specifically for Blue Cross. So I looked at the statistics for people who are purchasing health insurance through the exchange, and 41% of those have plans that are considered high deductible. So the provision that you really need to add to make it so we don't contradict the IRS rules would prevent them from benefiting from this piece, because we're not allowed federally to offer first dollar care. And then our two other major plans that this would impact are the state of Vermont employees, which have either no or very modest cost share, and then VHI plans. So 90% of all employees with a VHI plan have what they consider to be a high deductible plan. The deductible's about $2,000 per person, and then VHI fills their health savings account with that amount. So yes, they must pay out of pocket, but it is fully covered by their employer.
So I just want to make sure what I'm hearing, which is this kind of bill wouldn't harm your customers. It wouldn't harm people who have Blue Cross Blue Shield or other health providers under the scenarios you're talking about. Do you see that this would help any certain population?
Not really. It's really going to only help people who have plans with copays. And usually the copays are modest. And like I said, at the Blue Cross formulary, this EpiPens are a first tier generic. So for most of our members, there's already $0 out of pocket. I haven't heard yet exactly where the concern is coming from, although I'm sure there is one. But I'm concerned that you're not going to address who you're hearing from, or you're not going to be able to address who you're hearing from.
Any more questions for Ms. Teacher? You're gonna be standing by for the rest of this?
Yes, I'll stay here.
Okay. Claire, the chair is yours.
Thanks.
Claire Buckley. Obvious MVP Healthcare.
Good afternoon. I am Claire Buckley from the Anaheim Public Affairs, and I'm here on behalf of MVP, which is not a new client to our firm, but a new client to me since Chuck Starrow used to do this and he retired. So I'm getting up to speed, and I haven't been in here yet this year. Haven't been in here for a couple of years actually, but haven't been in for MVP. So I thought I would just give you the highest level about what MVP is. And, it's a regional, community-focused, not-for-profit health insurance provider that covers all of Vermont and New York. And it's been licensed as an HMO since 1993 in Vermont. Do you want me to, I'm not sick, I just put this on because everyone else is wearing it and I want to be respectful. But can you hear me?
Yes.
Oh, I thought you were going like that, like you couldn't hear me, so, sorry. We've been licensed since 1993 in Vermont, and so we've been here for 25 years. And MVP has more than 40,000 subscribers in Vermont in qualified health plans, large group, and Medicare markets. And we have a comprehensive local network of providers, and we value our local partnerships with things like the Vermont Blueprint, UVM, Health Advantage, and other local healthcare reform efforts that Vermont has undertaken. We are participating in those. So with regard to the bill S65, we have very similar concerns to what Sarah had talked about. As far as cost sharing is concerned, I actually spoke to Senator Cummings about this bill this morning and wasn't planning on testifying today. And then she said, well, I would like you to come in. So I don't have MVPs. I've reached out, but I haven't received them yet. MVPs specific cost sharing requirements for EpiPens, but I can get that for you. I don't expect that it's significantly different than what Sarah said, but I'm sure there's some difference. But I don't have that, but I can say that relation to cost sharing in general, this bill would require that EpiPens be covered at no cost to the member. And while we appreciate that out-of-pocket costs can serve as a barrier to accessing care, there are some important policy considerations. And one is the qualified health, high deductible health plan situation that Sarah mentioned, which limits the applicability of this mandate because you can't affect the people that are in those plans. So we would also request that exemption for, high deductible health plans be included in the bill. It's not in the bill as it was introduced. And second, we would like you to be mindful of the costs and affordability issues in Vermont. And when you eliminate cost sharing for one thing, it might not seem like a lot, but over time it adds up. I will say the Senate Health and Welfare Committee this morning advanced S37, which is, one of the SHIELD bills that we have here in the legislature this year. And one of the things that it does is it prohibits cost sharing for abortion for commercial plans only, not for Medicaid. So it's just another example of a bill that has no cost sharing in it as well. And when you look at the cumulative effect of all of it, it just, to pick one thing over another, an EpiPen over some other drug, or it's a policy issue and one for you to decide. But we do worry about affordability over time. And if you continually say no cost share, what it does is it either cost shifts it onto the premiums, or because some of the plans, you have to have a certain percentage of cost sharing where in these ACA plans, it just puts the cost sharing on all the other drugs or all the other procedures to increase the cost sharing for other things. So those are just important policy considerations. That you should consider, and we agree with the effective date as well, that would need to be addressed. And you can find the language for the high deductible health plans in the SHIELD bill I call it the SHIELD bill, but it has a very long name, that they passed out of Senate Health and Welfare Committee today, because they did include that in there as well. So that's my testimony. So we have some concerns about the bill, but they're more about just overall costs and continually to say no cost share on this, no cost share on that, no cost, and pretty soon it's like, well, who's paying the bill?
Chips.
Could you articulate, characterize the profile of the people that in that high deductible program that this can't benefit? What is the nature of the people usually subscribing to those plans?
Well, and I'm glad that Sarah Tijoux is still here because she has been working in this area for a long time. And is it okay if I ask Sarah? I mean, is that appropriate?
The ball's being lateral to you. You decide whether you want to catch it or not.
Thank you. Sarah Teachout with Blue Cross and Blue Shield of Vermont. In our experience, it's people who are choosing to buy high deductible health plans are usually choosing a plan with a lower monthly premium and would rather either they think that they won't need care or that they'll pay at the time that they need the care. And a lot of times these plans are paired with a health savings account that either the person who's purchasing the coverage or their employer fills with funds to use when they have out-of-pocket expenses. And there are tax advantages, having spent quite a bit of time working on the tax side of things. There are some pretty significant tax advantages to having a health savings account. So that's another reason that they're sometimes chosen.
Follow up. Do they skew to the higher income? Do they lower end? Is it across the spectrum?
Yeah, that's a great question. I don't know the answer to.
Thank you.
Who would know the answer to that?
I think that DEVA would know because they would know what portion of purchasers are using advanced premium tax credits to lower their premiums when they pick the plan. So the Department of Vermont Health Access would have an idea, a rough idea of who's buying the plans. But over 90% of people purchasing through the exchange right now are purchasing plans with federal benefits. I would say that on the employer side, it's become a much more popular kind of arrangement. And I think that it saves money for self-funded employers if they're not having to pay premiums and only pay when their member needs care.
Any other questions for our witnesses on this subject?
You know, I would add that in studying this bill a little bit, it looks like it doesn't apply to Medicaid. That would be my take on this definition. Just as an FYI, I'm not saying it should apply to them, but it's similar, like the abortion cost sharing that was just, no cost sharing that was just passed out this morning in Senate Health and Welfare also is not going to apply to Medicaid. So it's just a consideration.
Looks like able to answer that question
About Medicaid?
of whether it applies or not.
Well, maybe your lawyer, I mean, that's because it's.
Another question for Diva?
You mean the bill doesn't
The
apply?
bill doesn't,
Yeah, I would imagine that's true, just by
because
nature
of
of
this
the
definition,
Thank you.
9402. That would be my read on it. I mean, you definitely could check in with your lawyer and make sure that I'm reading it right, but I just happened to notice that today, actually. So,
And Medicaid does have a copay.
you know, I don't know what they have for EpiPens or, I'm not sure.
Well, the definition in the statute says health insurer means any health insurance company, nonprofit hospital, and medical service corporation, managed care organizations, and to the extent permitted under federal law, any administrator of an insured, self-insured, or publicly funded healthcare benefit plan offered by public and private entities.
Oh,
That's the definition of commercial
so
insurance.
maybe I'm,
That's health insurer.
Oh, I think, well, the bill says inaccurately you do commercial insurance coverage.
But in terms of the reference,
Mhm.
in the statutory reference, I believe, is to 18, excuse me. Section again. Now, that's the section.
Okay. I suppose Stillage Council.
So-
Yeah,
So again, it would need clarification, but just reading it, that's
okay.
what it says.
Well, if that's the definition, that sounds like it would include to the extent allowed by federal law.
Whatever that means.
So it's a pretty wide net.
Well, thank you. If there's any more questions, I'm happy to answer them or.
Thank you.
All right.
Which brings us to an act relating to the sales tax exemption for advanced wood boilers. And we have, once again, Ted. Emily.
They might only be back at 2:30 or? I have no idea.
Yeah, I think they'll be back at 2:30, so we could take a.
In which case, we have a whopping big 5 minutes, and 30 seconds. Free time.
There's a lot of coffee.
It's here till 2:30. We're still live.
People know.
And we're about to re-enter discussion of S93, an act relating to the sales tax exemption for advanced wood boilers.
Right.
The floor is yours, sir.
All right, I'm going to share my screen because I do have a fiscal note on this one. Where did this? Sorry, Jill, I think I somehow kicked myself out. All right. Okay. S93 would extend the date of repeal for the current sales and use tax exemption for advanced wood boilers from July 1, 2023 to July 1, 2025. As defined in statute, an advanced wood boiler is a boiler or furnace that is installed as a central primary heating system rated at high efficiency, meaning that it has to be more than 85%, that it contains 1 week fuel storage, startup and shutdown. And then there are other efficiency standards. At JFO, we estimate that this exemption costs currently between $36,000 and $60,000 in foregone tax revenues to the education fund. This is based on an estimated 40 systems that are installed every year. They generally have a cost around $20,000, $30,000. Services don't incur sales tax, so the equipment cost is a little bit less. And so this is where we get the cost from. I don't know, I can provide other information for the committee as needed, but this is the fiscal note that we're presenting.
Those numbers again were?
They were 36,000 and 60,000 per year. And since these are currently foregone revenues, it wouldn't be adding to it because this is already in effect.
I know this would drastically change the fiscal note of the bill, but I don't know if you heard, we had discussion about other energy appliances, other energy purchases that might benefit from Inflation Reduction Act incentives right now and what it would cost to exempt those.
Sure.
And I don't know if that's like how long it would take to get an estimate of that.
That is, I could definitely do some digging into it.
Like heat pumps and
Sorry.
like heat pumps and, you know, I actually don't, beyond heat pumps, I know that advanced wood boilers are in the Inflation Reduction Act as the allowable.
That is correct, yes.
So yeah, all of the, like, I don't know how long it would take to find all of those.
Conveniently, next week is town meeting week, and I'm not taking time off, so I could do a little bit of digging into that and give you an update kind of in the middle of the week and see if there's something that we could start to look at that universe.
That would be helpful.
Who in our present governmental system anoints a wood boiler as being advanced?
Yes, the definition is in statute. So the cited reference is 32 VSA 9701, section 55. There are a lot of definitions in that section. But that is where it's defined using those 4 criteria. And so it really limits the share, right? It carves out pellet stoves and wood stoves, because it has to have at least 1 week of fuel storage, it has to have a certain efficiency rating, so it really narrows the field.
So someone other than yourself, give us the details on what qualifies, what doesn't.
That is correct. Yes, I can only refer to the statute on that one, yeah.
I had a 1935 designed wood boiler that lasted 40 years. I would hazard to guess that it doesn't qualify as advanced wood boiler.
That is entirely possible, yes.
You don't want to guesstimate.
I don't want to guesstimate.
Maybe being too pessimistic.
It is true. That is, sometimes at JFO, we do get a reputation for being a little pessimistic.
On that Mark was being pessimistic.
Mm-hmm.
That wood boiler gave up a few years ago. Ended its career.
After 40 years, that's not too bad.
Thank you very much.
Sure.
Further questions? And that, my goodness.
I guess I'd say before I vote on this, which I support, because it feels like a positive thing to do for a negligible amount of money, I just want to wait until after town meeting to see if there's other things we should include for parity and just
Well,
good
it's
policy.
not the acting chair here today's intention, to call for a vote on this.
Okay, no.
Which brings us next to testimony by Doug Hoffer and Tanya Morehouse, scheduled for 3 p.m. on an act relating to the creation of a project-based tax incremental finance program. TIF. And the committee is free to take care of what they would like to do between now and when Mr. Hoffer is prepared to speak to us.
Chairman, I was out of the room at the earliest part of this cycle. Did Senator Chittenden have anything to say about this bill? The one we were just talking about.
So on this one, I definitely support it. I think Senator Persick, when he came in and spoke, made the strongest case for not only considering the extension of 2 years, but maybe just, eliminating the sunset. But I think Senator Ron Hinsdale spoke really well that we should look at what we're currently collecting in sales taxes on other things that we're encouraging for the same reasons we're considering this, which I believe are the heat pumps. So if that, I don't know if that speaks to your point, but I definitely support moving this bill forward. Modest amount of money to support local wood industry as well as cleaner ways to heat our homes.
I didn't think I was that late. Sounds like a lot got said while I was gone.
It's interesting, advanced wood boilers are becoming used more and more. Was apparently northern Portugal and Spain are growing eucalyptus trees on a 20-year cycle, 17-year cycle for making wood pellets. The forests are being cut and replanted.
Since we have time, we don't tax clothing, we don't tax food, but we're taxing heating sources in this case. Well, if we don't do this, and it seems to make sense that we, within our tax policy to continue this, and it's part of quality of life, keeping people warm in the winter.
Perhaps that's why the bill has been offered.
Yeah.
We tax machinery. Chainsaws.
So are we recessing so far?
Yeah, we'll shut down here until 3 o'clock when Mr. Hopper comes in to speak with us.
Tax, no.
Sorry.